So Nike, first off, let me say this. So I've started a position in the public account. I've been trying to buy this stock very aggressively here recently. I'm up to 343 shares, up at about $34,000, right? We're down about 3% on the position right now. First off, I would prefer the stock to be under $105 for the next 6 to 9 months. This is probably in my top 5 stocks of stocks I would love to buy over this next 6 to 9 months. So I'm hoping it stays low here in the short term. That's my hope. But the one thing I'll say, if earnings are good, the stock's probably popping 10 to 15% after hours tomorrow, if the earnings are good. And we'll see if the earnings are good, and we'll speak about that in just a moment. The thing we have working against Nike in the short term is China. China is a big problem. The Chinese economy is weak. American companies, are not doing the best in China right now. We've heard weakness out of Apple. We've heard some weakness out of Tesla, and companies like Nike, even companies like Starbucks have, not had the best thing to say about China in the short term. Keyword is in the short term, right? We know Tim Cook's over there right now trying to do whatever he is. He might be going, person by person trying to sell them iPhones right now on the street. I don't know what's going on, okay? The low expectations. Nike's got extremely low expectations for not only this quarter they're in, but next quarter as well, which is what Wall Street really looks at. What numbers are they about to report, and then what's next quarter's guidance. The company's revenues are expected to go down this current quarter they're going to report, and then next quarter up 2%. So the expectations are about the lowest you've seen on Nike in years, just to be quite frank. Very low expectations. Now, when I look at EPS, I think analysts are way off. Nike's doing big cost cutting this year, and I think it's going to bode very well for fiscal 2025 numbers and fiscal year 2026 numbers. And so I think analysts are way too low with their EPS projections for this company overall, especially given the fact that real wages are starting to pick up and starting to get in a much better, healthier place for consumers out there. I think that bodes very well in the United States of America as well, right? Now, you think about this logically, right? China, weak. Cost cutting. Retailers want lean inventory. Inventory adjustments, weak retail sales in the U.S., right? Because we got some retail sales data recently that was a little weak. Now, you think about all those things, and what are all those things I just showed you right there? Those are all short-term things, right? Oh, the Chinese economy is weak right now. Oh, cost cutting. Retailers want lean inventory right now. Oh, this retailer had too much inventory, so there's inventory adjustments and retail sales. All those are short-term things that come and go, right? Chinese economy could be seen as weak. 3 years from now, Chinese economy could be seen as the strongest economy in the world, right? Like things change pretty rapidly, and I've seen them change very rapidly over the past 15 years, right? What about things like brand strength, global presence, a growing TAM, total addressable market, growing worldwide wealth, a growing middle class in China and India, an entrenched marketing presence that's unparalleled, top-tier executives, top-tier board of directors? What are those? Those are long-term factors, right? And so when I look at a stock like Nike or any stock in general, you have to differentiate between, especially as a long-term investor, somebody that's focused on the coming years, you have to differentiate between negatives that are things that will come and go and positives that are lasting, right? And so, I got my little Jeremy Lefebvre's hotel over here, the Flapjack Flipper Resort, right? And the number one saying I have here is build a portfolio you'll be proud of years from now, right? That's so important because a lot of people get so focused in the short-term stuff that they forget the long-term stuff. You got to build a portfolio to be proud of years from now. So when I think about a stock like Nike and trying to add this stock, will I be happy that I bought this stock in 6 months? I don't know. I might not be. We'll see. I would say it's a coin flip if I'm happy or not. Will I be happy I bought Nike stock 6 years from now? I think there's a pretty high probability that I'll be very happy I bought Nike 6 years from now, right? And if you think about a lot of these positions, right? Oh my gosh, made so much money in Tesla stock, right? That didn't happen overnight. This has been a long time in the making, right? Tesla, I have shares I acquired in Tesla all the way back here in the public count, May 3rd, 2019. May 3rd, 2019. Look at these shares I have at Tesla here. I bought 435 shares, May 20th, 2019. Cost $13.12, right? That's a long time in the making. Metastock, nowadays sitting on a $657,000 gain in the stock, 300% plus up, right? This didn't happen overnight. I have shares in Metastock, folks, all the way back from July 27th, 2018. 2018. Look at these shares here. I bought a bunch of shares here. 77 shares right there. I bought them for $137. This was December 7th, 2018. So I have Meta shares from 2018 in this account. I got shares from other years. I got a bunch of shares from 2022 when that crash was happening, right? I'm sure I got some shares from 2023 as well, right? You think about a stock like ELF, 2,654% up on this stock, right? It didn't happen overnight. Those shares, those 1,000 shares that I paid $7.28 for, so it was less than a $10,000 move there, right? Those shares were acquired February 27th, 2019. 2019. So I take you back here and, build a portfolio you'd be proud of years from now. Add to positions that you would want to hold for many, many years. Like, let's say you had to buy a stock and you weren't allowed to sell that stock for the next 6 years. How would you build your portfolio? How would you construct your portfolio? You could not sell it for the next 6 years. It was just stuck there, right? That's the way I like to think. What would I be happy with if I could not hit that sell button for 6 years and the money's just stuck there? What type of companies? Because you start to think differently when you start to think in a context like that, where I can't sell it, right? And you stop kind of thinking about all this short-term stuff and, there's this negative thing here and there's this and that. No, think long-term about this stuff, folks, okay? Listen, with great assets, time is on your side. When I talk about assets, I'm talking stocks, I'm talking real estate, right? When it comes to bad assets, time is not on your side. It's a very different situation. You're just trying to make money quick, short-term, and out, right? But with great assets, time is on your side. You let that play out, right? With the greatest companies in the world, time's on your side. NVIDIA, time's on your side. Apple, time's on your side. Google, Meta, these greatest of the great companies, Tesla, time is on your side, right? Same thing if you own a piece of real estate. Let's say you own a great piece of real estate in, Manhattan, okay? Or a great piece of real estate in, Newport Beach or wherever. Time's on your side there. Things might get rough in the short term. This might happen, that might happen, all this negatively affected, all Rona happened. Also, New York real estate wasn't as popping for a few years, right? Because people left the city for a bit and went to rural areas, whatever the blah, 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 okay? Bottom line is 10 years from now, if you had to bet your life on it, is Manhattan real estate a lot more expensive or a lot cheaper 10 years from now? I think you know what bet you're taking if your life's on the line, right? That's the way you need to think about stocks in real estate. Time's on your side. If you own not good quality stuff, then time's not on your side. You need to get out of it quick, right? Think of a house flipper. A house flipper, they're just looking to try to get in, get that thing renovated, and they're out. They're out. They don't want to hold it because many times they're not even actually holding a great asset. They're just buying it because they think there's some sort of arbitrage there. They can make 20K on that flip or 50K or 10K or whatever the money is, right? And so same thing with the stock market overall. Great assets, time is on your side, folks, okay? All right, guys, let's get into this. First up here, number one stock I'm buying, just reported what's going on here, okay? So this particular stock I've been buying pretty aggressively here recently. So right here was my first buy in the public count here. This was December 28th, 2023, so right before New Year's. I bought 100 shares there, 5 shares, 10 shares, 185 shares I bought right here on January 17th, then 5 shares, 13 shares, 4 shares, 8 shares, 8 shares, 5 shares. And I've also been buying the stock very actively recently in the Patreon portfolio as well, and I do own it in another account, okay? So what stock is this? It rhymes with Pikey. It is Nike. Okay, Nike stock. So Nike stock, I'm up to 343 shares in the public count, $34,000+ in the stock, and this has been a stock I've been wanting to buy. So the earnings came out, the stock's up 4% plus after hours here. Now, in regards to the actual numbers, they're not good. They're not good. I gave them a D income statement here overall. Whenever I look at income statements, I always just look at it unbiased. Whether I have a short position in that stock, long position, or no position, I just call it the way I see it. And I do that for all my stocks and all stocks in general. And so Nike, this was a D income statement here. Revenues didn't grow for the company, right? Well, technically they did, but really no growth. Cost of sales was down about 2%, so that was good, right? Gross profit was up 4%, so that was good. Gross margin went up to 44.8%, so that was good. But demand creation expense went to 10% up year over year. Operating overhead expense was up 6% year over year. Now, you want to compare these numbers to revenue, right? And so if your revenue's at basically no growth and your demand creation expense is up 10%, overhead expense of 6%, total selling general administrative expense of 7%, that's not good news. You don't want to see those way outpacing your revenue growth overall. So as far as those climbed to 34% That's not good there as a percent of revenue, right? Income before income taxes was down 5%. Net income for the company was down 5% year over year for Nike. So not obviously an impressive income statement at all out of Nike, which doesn't come as a surprise to me really at all in regards to that. Now you'll see a lot about Nike beat their earnings, what analysts were expecting and things like that. And it's always cool to see if a company beat earnings or missed earnings, but what the actual numbers are matter more than if they beat or missed analyst estimates, okay? Now, in regards to Nike, right, you might say, okay, why would you own a stock that, is reporting a D income statement here at the moment, right? Or at least what I would grade as a D income statement. The reason being is I'm in the stock for the future, right? I'm buying the stock now because I believe the story is going to get a lot better over the next couple of years here. And so we're in their fiscal year right now. Their fiscal year ends at a very weird time. It ends in May of 2024, right? And then starts a new fiscal year. So right now they're doing a lot of cost-cutting measures and those sorts of things, and those are going to be going over effect in the next several quarters here. But as far as the following year and the following year, I think their EPS is going to be much higher than where analysts are at for this company overall. Now, I was watching some Fast Money earlier. They were talking about competition. They were talking about, Hoka. They were talking about On and these sorts of shoe companies that have come out of nowhere the last 2 or 3 years and are like competitive threats to Nike, right? And the thing I'll say overall in regards to that kind of thought process is these companies come and go. Allbirds is nearly bankrupt now at this point in time. Allbirds was taken off like crazy just a few years ago, and the stock's down to 74 cents. Don't be surprised if you hear a bankruptcy coming for Allbirds in the next year. We'll see what happens there, but it's not looking good for them, right? Under Armour stock is down 64% in the past 5 years. It's all the way down to $7 a share. Things have gotten so bad at Under Armour that the founder of the company, Kevin Plank, is returning as CEO because the company's in such a bad spot now at this point in time, right? And so the important thing to understand about the clothing industry is, did you ever hear what Elon Musk said in the past? Elon Musk has said in the past, Tesla and Ford are the only car makers in the United States that haven't gone bankrupt. And I don't know, he might be right about that. He might be right about that. I guess he's probably right about that, right? And so, like the auto industry, it's hard to make it, right? And it's hard not to go bankrupt. Same exact thing in the clothing space. It's very, very difficult. You can come out and you can be a popular brand for 5, 10, 15 years, and then next thing you know, all of a sudden you're not as relevant, you're facing bankruptcy, or you have to be acquired by another company or something like that, right? Nike's really the only company in this whole entire space that can make it through decade after decade, generation after generation, right? The 1980s, 1990s, 2000s, 2010s, 2020s, it's a very special company. When you can make it through decade after decade, several generations, that's Nike at the end of the day, and there's very few that can do that. So am I going to be buying more Nike shares? And the answer is likely yes. I will likely continue to acquire Nike shares as just a great long-term company to own. Overall, I love the diversification it adds to my portfolio. Let's talk about Lululemon. They give a big warning in regards to the U.S. consumer. Then we'll get into FedEx, what that means for the economy, and then PayPal, Meta, all those sorts of things, okay? So Lululemon's crashing after hours. It's down double-digit percentage, down over 10% after hours here for Lululemon. Now, in regards to Lululemon, the bad news, the very bad news, is sales in North America rose 9% compared to 29% increase in a year ago period. So there's some sort of massive epic deceleration going on in North America for the company right now, which is not good to see. Because when you go from 29% growth to 9% growth in 1 year, now people are going to be like, what's growth at this time next year? 3%, 4%, 0%? Are we going to go negative? Could revenues go down year over year by this point next year? People start getting very, very concerned. Now, Lululemon said, as you heard from others in our industry, there's been a big shift in the U.S. consumer behavior of late. And we're navigating what has been a slower start to the year in this market. Now, that's basically saying bad numbers are coming, right? Oh, you thought these numbers are bad, just wait till later in the year. You're going to see really bad numbers. That's my interpretation of kind of what they're saying there. They're basically prepping up investors in Wall Street for likely bad numbers coming over the next couple quarters here, right? But they're kind of blaming it on you. They're blaming it more on U.S. consumer than something that they can control, right? So that's a little strange overall. I don't know. Here's the deal, okay? Lululemon, it was just back in January, they had raised their holiday outlook. Lululemon raised their fiscal fourth quarter outlook. I don't know, man. Things like change pretty rapidly in regards to Lulu there. Is it really is it really the consumer or is there something going on with Lulu? If we look at their income statement, they're phenomenal. It's an A- income statement here. It's absolutely amazing. Revenues, $3.2 billion versus $2.7. Cost of goods sold, they kept that in check. Very nice. Gross profit went to $1.9 billion from $1.5. Now 59.4% as a percent of gross profit of revenue. That's incredible, right? Incredible numbers for gross profit. If you look at selling general administrative expenses, that was up year over year for the company, so that's kind of bad. Now, last year they had a one-off here. If you look at impairment of goodwill and other assets, restructuring costs, it was $407 million. So it was an epic one-off. So it makes their profitability look like it was skyrocketing this year. And it's good numbers, but it's not as epic as it seems, because if you have a one-off $407 million expense last year, it's pretty self-explanatory, right? Income from operations went up to $913 million. That was about 28.5% as a percent of revenue. That's an incredible number. Net income, $669 million. And basic EPS, $5.30. Diluted EPS, $5.29. So very good numbers. But I think Lulu's getting themselves in some trouble here. Okay, let me explain. So the company, if I went to their front page here, and they're trying to push into shoes, right? We just spoke about the shoe market just a minute ago, right? Athletic shoes, Nike's the big dog there. And then you've got a lot of upstarts like On, Hoka, and maybe another company or two, right, that are there. And then you got Lululemon trying to come in this space. And it might seem like, oh, this is just great. So many people buy shoes. This is a great opportunity for Lululemon. Could be. It also might be a huge money-losing business. You might say, well, how are they going to lose money on this? They're probably going to sell those shoes for $100. And, they make them for $30 or whatever, $20, maybe less than that if you cost, you factor in the shipping fees and all those sorts of things. Well, the big thing you got to take into account is you got to spend a lot of money on marketing if you want to sell your shoes, right? It also needs shelf space in your actual physical stores. You need to put promotional activities behind that, which all cost money, which can then, if your sales volume is not high enough, you can actually lose money. And I know it's hard to believe, when you're making shoes for cheap prices and you're selling them for expensive prices, you could actually lose money because of all the marketing you spend there. I scrolled down a little further on the page and, they were selling dresses and these zip hoodies and these sorts of things. And so I don't know where Lulu's taken their brand or what they're trying to do here, but it seems like they're, I don't know, it's seeming to me like they might be getting a little bit lost here at this point in time, right? Now, the main issue for Lulu in regards to the stock is that when these earnings priced to perfection, when you're trading at 30 plus, you're a clothing company trading at 30 plus PEs, you're kind of priced to perfection, especially when everything in your business is already going great. It's not like a Nike situation where, Nike's been going through some trouble here over the past year or two, right? And yet Nike trades at a forward P in the 20s. Lulu, it's kind of like everything's been going great for them and they're trading at a forward P in the 30s. So they were praised to perfection going into this. So any little thing that went wrong, the stock was ready to go down in quite a substantial way, right? And I spoke about Chipotle stock in last night's video. That's another one of those stocks that if anything goes wrong, you'll see it drop, double-digit percentages there. So in regards to Lulu, do I look at this and am I scared about U.S. recession based upon what Lululemon said here? I'll say this, okay? First off, who's Lululemon's demographic? Lulu's demographic is a lot of folks that are, at the lowest middle class, but a lot of upper middle class folks, right? A lot of folks that have incomes $80,000 plus per year, right? A lot of household incomes $100,000 plus per year. So I haven't seen those consumers necessarily pull back in other spaces yet. Could happen. But I haven't seen pullback yet in other spaces that would make me say, oh yeah, U.S. consumer is really bad right now. I've seen too many companies come through with really strong earnings this year, right? And even a Nike, this was expected to be a bad quarter, it came in better than Wall Street had expected. So when I look at it from that angle, I see a Lululemon here that there might be actual fundamental issues going on with Lululemon's business model. And so I don't want to just chalk it up as, oh, the consumer is bad right now or something like that, okay? So that's kind of my view there. We'll see where this goes over this year in regards to Lululemon. I think it's a big year for Lululemon to really show that they can get through this and make it out to the other side and, keep these big growth rates going. Because, yeah, when you go from 29% to 9%, where are you going next? 4%, 3%, 2%, right?